The National Centre for Social and Economic Modelling says a 25 basis point interest rate cut benefits those households led by 25 to 64 years old by more than $300. But for those over 65, it actually reduces their income by $29 a year, a lot more if the interest on your savings is your only source of income. Official interest rates are low, but they're likely to go even lower.
The next cut, we're either going to see one in April, the April meeting, or the May meeting. And the reason for that is the economy is still subpar, the outlook for business investment's very poor, inflation is low, the Aussie dollar's still too high.
That's bad news if you're earning an income from bank deposits.
We've seen literally a collapse in bank term deposit rates. In fact, they're at levels that haven't been seen since the early 1950s.
If you prefer to play it safe and stick with cash accounts,
go for the highest interest rates you can find. Use comparison sites to compare these deals. Keep track of what savings account rates that you're on and what conditions are associated with getting those high interest rates or when the intro rates fall. Use automatic savings plans and save regularly to those accounts.
Despite low interest rates, Australians are saving at record levels. More than $900 billion is being held in cash and deposits. That's almost 23% of financial assets and above the decade average of 20%.
The shadow of the GFC is still looming over investor sentiment. People haven't got back to the degree of confidence that they had prior to the GFC.
The Australian share market is now trading close to its pre-GFC peak, but it's taken 7 years to get there. Its recent rally has been driven by high-yielding stocks.
They're paying a really attractive rate of return of between 6 to 7% as a grossed-up dividend yield. So that can be quite compelling for people sitting in low interest rate cash-type investments.
However, shares don't always rise. Corporate or government bonds can be more conservative and pay a rate of interest for a fixed period of time.
Depending on the rating of that bond, like whether it's highly secure or less highly secure, i.e. the risk associated with that, will determine the rate of return that they're willing to pay you.
The other, less popular option is to spend less. And the Reserve Bank will meet next on Tuesday.